Welcome back to the channel. On today's episode, we're going to be looking at the history of bubble and market crashes. If you check everywhere online, because of what has been happening in the market, especially from the month of January 2022, the market has been trending down. The S&P 500 is about 10% down to date, while the Nasdaq is about 12, roughly about 12, and the Dow Jones is about 10. People are freaking out about market bubble and market being in correction territory. Some are calling it crash. When you check on YouTube, the videos you see on YouTube is about crash, crash, and crash. Whether it is bubble or crash, what history has shown and what the recent crash, 2020 coronavirus crash, has shown is that patience is key when it comes to equity investing. You do not invest in equity with the money you need in a month, 2 months, whatever, except you are just gambling or you are day trading and or swing trading. Equity investing needs time, and that is key to investing. Now, looking at the S&P 500, the Nasdaq, the Dow Jones, they all have been down. They have been in correction territory since beginning of the year. Now, you are freaking out because you think, oh, equity or market should always go up. There's this notion that, oh, investing in equity, it will always go up. Stock will always go up. We will look at different analysis. We will look at different charts to see whether it is true that market will always go up. In my research into market crash and bubbles, I have come across two very informative websites, Morningstar and Busrt.com. Some of the charts I'll be using are from both websites. For references, you can look at them as well. You will see the history of market crashes since the first crash in 1929, till date. You will see some of the reasons why crashes occur. Some of the reasons are not even about the market itself. It's about things that are happening generally in the economy, environment. Market sometimes is not the economy. The economy sometimes is not the market. There are times that the two of them are in the same direction. But however, you need to see over the long time, you would see that there is a divergence between the two. Also, valuation. You may think, oh, there's high valuation, oh, there's this. Look, currently we're facing the issue, the tension between Ukraine and Russia, and it's causing markets to rattle and investors are wary and all that. There's high inflation. The inflation is not caused by the market itself. This is a monetary policy by the Fed. Also, there are other things that are impacting the market. Look, you can argue the fact that for every seller there's a buyer, for every buyer there's a seller. So what is bubble? If I want to sell and you want to buy, we exchange, period. So you will see that there's argument for and against market bubble and why market crashes. In researching, I found out that the 5 biggest market crashes we've had in history, starting from the 1929 till 2020 March coronavirus crash was the quickest in recovery. The other ones took time, maybe 10-15 years down the line. But the coronavirus tells us differently. It tells us that government around the world, even the US government, I would not be looking at the market, staying in the state of unresponsive for years like it happened in the past. This was why there was intervention in the first place. I don't want to go into the fact whether the Fed made an error by initially thinking inflation was transitory. They could be wrong and all that. I mean, it shows already. These are just the adverse effect of pumping money in the market for the inflation. However, the recovery was fast for 2020, and we are here as we are here now. Let's have a look at some of the charts, that I was talking about, and from the history, from the website Morningstar and harvest.com. You would see that, yeah, there's always been crash in history. They've always recovered. The one thing that is common to all is that eventually, after every crash, the market will set a new high. Whether it is soon, whether it will take longer, whether it will be quicker as that of coronavirus, nobody knows. If we're going to have a crash in year 2022, is it not too soon that we had a crash in 2020? Now, another crash. I'm not sure this is, I'm not confident this is going to happen. We just might be in a bear market for longer than expected, or we're still in correction, and the correction might linger longer than we all anticipated or we all expected. By March, there will be meeting of the Fed. We would know the direction of the Fed policy against inflation and the interest rate hiking and all that. There will be multiple interest rate hiking this year. We already know that. By March, investors will have a clear direction. You would know if it's the bubble, fine. If it's the crash, we would know. This is from Morningstar. We are looking at market crash timeline growth of $1 and the US market. This is from 1870 till 2020. What I need you to see is that on this chart, look at the recovery of the 2020 crash. That was the fastest in history. The fastest. Look at it. From January 2020 and the crash of March 2020, look at it. The recovery was fast. It was the fast in history. Now let's look at this other chart. These are the timelines of different crashes. The World War, influenza, okay, yeah, the 1929 crash, Great Depression, the inflation in Vietnam, the inflationary bear market, Black Monday, depression, a different. This just to show you that it is the market fundamental or market structure that you will have ups and downs. There will be season of crash, there will be a recovery. Let's have a look at now. Look at it here on this chart. It's also the market crash timeline, but you need to see from 1870. Look at the post-war bear. You would see that there are times that when bear market and all that, market has not always been straightforward, up run. Like people always say that, oh, the market only goes up. There are season, there are period of down where we'll be in the bear market for some time. And you can see, but this usually follows after a correction or a crash, where we have bear market, but there's always a period of expansion afterward. Let's have a look at this. Let's have a look at this chart. This chart shows you S&P 500 cyclical, adjusted P and reversion. Now look at it. This is where you have the previous the bull market peaks. Now what you need to see is after every peak, there's a contraction period. And after this contraction period, you have an expansion again. After expansion, you have a contraction. For whatever reason, when the market is really, 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 really high, it gets to a point and a crash will happen. Whether you call it contraction or an expansion. But look at it. Look at the trend. So market has not always been straightforward on, the market will always go up. There are seasons, there are period where it doesn't look like that. Now look at the expansion here. It looks very great. Yeah. But look at it. The contraction. The fastest one in history is the March 2020 recovery. Let's have a look at the S&P 500, Dow Jones, and Nasdaq on a more chart to see down on the price action and all that. We are looking at the Dow Jones Industrial Average. Now we're looking at a monthly chart. I want you to put the focus here, starting from here. This is 2010, year 2010. Now, look at the way the red candles you can see here. Okay, let's put our focus here, which is year 2011. See, this red candle that you're looking at, in the next 10 years, this is where we are now. The next 10 years or so, this candle that you are saying for March 2020, it would not even look as big as this. See, because of where we are now. Because we're here at present, it looks, oh, we're going through this at the moment. It's a correction that we're going through. Now let's draw a trend line. See this trend line? Let me draw this. You can see that uh, in the middle of these lines, we have that time that the um, market goes out of the line. Yeah? And every time that happens, is either we're in correction or a crash. This is the crash of March 2020. You see? Now, there's a support here now. This support is holding here. Now, okay, here. This is where we are now. We can look at it on a daily, on a weekly chart. Look at it on a weekly chart. Oh, the line is already there on a weekly chart. It looks bad. It looks huge now. If it in 5 years' time, it would not even look this bad. Now look at March 2020. And this is the same. March 2020, we went further down below 200-day moving average on a weekly chart. You know, it was about 40% down. Let's have let's have a look at it. Look at Nasdaq. Now look at the Nasdaq. It is even clearer here. We are on we're on a support here with Nasdaq. Hmm? The resistance is here. So you can see that in between the resistance and the support, there is 50-day moving average. This is the 20-day moving average on a weekly chart. What you also need to observe is the trend. The trend is bullish, just like the Dow Jones is bullish. The trend is bullish. We're still in the bull market. See, we're still in the bull market. Let's have a look at the S&P 500. S&P 500. Let's have a look at it on a monthly chart. Monthly. Look at it. I actually did this earlier when I was going through it. Now you can see. Let me take this off. It's the same. This is year 2020, the March 2020. Yeah, the crash. This was the other crash as well. The dot-com bubble. It's not even visible again because it's in the past. So it means that yeah, after this crash, there's a new high. The market set a new high. After this crash, the dot-com, there's a new high. The market set a new high. Trying to time the market, you will always be behind rather than be in the market. Now weather the storm. When you weather the storm, the market pays more returns to people who actually weather the storm, who are not timing the market, who are in the market. It is not time in the market. It is time in the market. It pays more for those in the market. Yes, if you have fun on the side, you can buy more. But don't just sell off and run away. Now look at it. Let's look at this on a weekly chart. On a weekly chart, it looks bad. Like, oh, we are down here. We are just sitting on the 50-day moving average. Yes, we're in correction, and that's it. We're in correction. It doesn't mean that even if it goes further down to a crash, if you have funds, buy more. You know, you dollar cost average. The market have history of paying back far more for people who weather the storm. Guys, we have seen different charts, and we have seen the S&P and the Nasdaq, including the Dow Jones in history. The mistake you would make is to sell and run out of the market. Don't forget, it is time in the market, not time in the market. It looks like if you have a lot of fund on the sideline, you might be better off. You never can tell whether there will be crash, whether there will not be crash. You don't even know. So the best thing to do is to stay the course. Stay the course. Patience is virtue, and the market always reward those who spend time in the market, not those who are timing the market. Thank you for watching this channel. I hope you have been able to get one or two things from this video. Please continue to support us by liking our videos. Tell your friends who have not subscribed to subscribe. Thank you. Goodbye.